Is this, people love the great rotation question because they always want to say, yes, it is. Very few people want to say, no, it's not. Where do you fall?
Well, I think we're all hoping it is. I mean, most active managers are struggling with the fact that if you're running a mutual fund, for example, you can't be overweight the Magnificent Seven just due to regulatory requirements and restrictions. And so we're all hoping for broadening for that reason, but also because that would imply that there's a broader economic well-being. I kind of use the terminology with our clients here at Rockland Trust that, the big tech companies kind of make their own weather, and they just kind of go up based on their own secular phenomena. What we're seeing and hoping is that the broadening will come as a result of the weather getting better. People feeling more and more comfortable and confident that the soft landing scenario that we're all hoping for comes to fruition. And the data that we've received over the last couple of weeks with the jobs numbers last week and CPI yesterday support that there's going to be a Fed cut. And ultimately that if it's the beginning of a series of cuts, should result in positive economic outcome and perhaps will manage the very, very challenging outcome of getting to a soft landing.
What happened today, Ron, that made the Dow move as high as it is?
Well, I think a couple of things. Consumer expectations eased off a little bit, which once again reinforces that the Federal Reserve probably needs to make an interest rate cut. Inflation expectations among consumers included in that University of Michigan sentiment reading that came out today fell to the lowest level we've seen in quite a number of months. And PPI for, coming in slightly above expectations wasn't really all that hot and doesn't change the inflation narrative much. And so I think, as was being said, the soft landing scenario looks quite good. The Atlanta Fed just upgraded its GDP forecast for the second quarter from 1.5% to 2% annual rate of growth. It still looks fairly Goldilocks here. And indeed, if it's going to broaden out, if the economy is going to stay in, lower interest rates generally will favor small caps as well as large caps. But they'll get that tailwind that they've needed. Yeah, no matter the cap.
Whatever kind of cap.
Whatever kind of cap. No cap. Yeah.
No cap.
So I borrowed that from my kids. I don't even know what it means.
No, I think it means not anyway.
Yeah, I know.
Hey, Mike, so the natural place my mind is going with this is, well, but the unemployment rate's on a 0.7 upswing from trough to peak right now. And what if it keeps going? And I know these cycles better than anyone. So have we ever seen a cycle where the unemployment rate starts to rise but then stops before it goes too far?
There was a little bit of a rise off of the absolute low in the unemployment rate in the mid-90s, but then it basically did just kind of stall out and either kind of hover or come back down at times. So, yes, there have been these instances, but, I know you're referring to these models that suggest at a certain point the unemployment rate does get upward momentum, and it does tend to sort of be self-reinforcing at a certain point. Broader point, I think, also that you're kind of touching on is this has to be kind of a growth scare and not the real stall. And so we'll see if that remains the case. I think, as Ron said, underlying growth still seems okay. It still seems roughly near or just below trend. And that'd be great if that's where we manage to settle out for a bit, especially because the earnings cycle is not exactly matched up at the moment with the broader economic cycle. It seems as if annualized earnings growth rates are going to be a little bit better than you might expect from a slow growth economy. So I think that everything can coexist at once for this interim period. But the way it breaks from here matters quite a bit.
David, you have an eclectic mix of stocks that you like that range from the consulting field to insurance to energy. Explain why.
Yeah, well, I think in this broadening theme, as we discussed earlier, I think if investors do get comfortable with a soft landing, they're going to look beyond AI. Obviously, the AI has been the driving trend in the Magnificent Seven's performance, broadly speaking. And so if, in fact, they're going to look more broadly than that, and we do have a normally shaped interest rate curve, that's very beneficial to financial services companies, particularly insurance companies that own large bond portfolios. So as maturities roll off, they'll be reinvesting those proceeds at higher interest rates in the intermediate to long term, which will be beneficial. At the same time, with insurance companies, particularly Chubb, there have been significant increases in premiums there. That's actually beneficial to the insurance carriers so long as people don't cut their coverage. Chubb tends to focus on a wealthier clientele and more affluent clientele who tend not to be as price sensitive as it pertains to hedging out risk. So we feel like Chubb particularly is in a very good position to take advantage of both of those phenomena. As it pertains to Accenture, we're very excited about Accenture's AI exposure. If you think about the enhancement that we're all going to get in productivity as general operating businesses, it's going to come from this technology that is very, very new. There are all kinds of new vendors, and IT departments in corporate America need to figure this out. They need help. And Accenture is particularly well positioned to help generally speaking, these companies sort through all that. So there's a couple of examples of things that we think investors will begin to focus on as they look beyond just AI-specific direct plays and begin to look beyond and what else could potentially benefit.
The way you have to go. I want to believe it's the Roaring '20s, Ron. That Ed Yardeni's right, and it's going to turn out that way. But again, it's pretty unusual to have a period where the unemployment rate rises like this, and a recession isn't coming, nor does it keep rising further.
I'm kind of in Mike's camp. I mean, you get this slowdown, that it is not necessarily, fatal in any way, shape, or form. And you also if you look at jobless claims yesterday, they fell.
Right,
even as the
better,
unemployment rate has ticked up. So, we're not hearing from companies that they're doing mass layoffs. You're hearing them on a more selective basis. And, a lot of it is having to do with industry-specific issues as opposed to economic issues. We're probably going to slow down. A recession, I think, would require inflation to spike back up and the Fed to tighten. And financial conditions are more than friendly as far as stock market is concerned. Not sure that's true on the credit side, but there's a lot of money sloshing around that's supporting the economy as well.